Both HCC and AMR reported earnings last week, and HCC went up over 23% after earnings. So today in this video, I want to analyze HCC's earnings and AMR's earnings. They're seeing their financial highlights from their earnings presentations and gleaning anything I can get from what has changed in the last 3 months versus previous quarters. So if you like this content, please like and subscribe, and let's get straight into it. So I've pulled up the HCC third quarter results earnings presentation. Let's go straight to the financial highlights. So here they have some really great updates to announce to investors. They commenced the highly anticipated longwall operations at Blue Creek 8 months ahead of schedule and on budget. This is pretty unheard of. This is wildly efficient on HCC's management's part to be 8 months ahead of schedule. This was anticipated in 2026 at some point, but now they have done this in 2025. So this is a huge update for investors and the company as a whole. Their commissioning towards full production is expected to be completed in early 2026. So they're very ahead of schedule and on budget on this project. And that is, you can see that in the numbers and the short terms that they're producing of met coal. Due to the accelerated startup of the Blue Creek longwall, the company updated and increased production approximately 10% and sales volume guidance for the full year 2025. So you can see that due to that acceleration, they are able to update their production volumes and sales volume guidance. They won the bidding for the federal coal lease sale of 58 million short tons of high-quality steelmaking coal reserves. And this is adjacent to their existing facilities and mining. So they're not going to have to really break the bank in terms of just setting up operations to start on this new land lease that they got. And so they won it with about $47 million bid. And so that's peanuts compared to how much they're going to make from 58 million short tons of met coal that they can sell. This also adds a lot of life to the adjacent mine. So that mine will just become larger and they will be able to add decades of life. They achieved record quarterly sales volume of 2.4 million short tons, including 378,000 short tons sold, partly due to the fact that they accelerated the production from Blue Creek. They also reduced the cash cost of sales, which is free onboard port, by 18% to $100.73 from a $123.45 per short ton, driven by a combination of variable cost structure, disciplined approach to cost control, and operational efficiency. Blue Creek is sitting very, very low on the cost curve. And then Mine 4 and Mine 7 are a little bit higher, but still in the first quartile of the cost curve. So still very, very low. And then they declared a regular quarterly cash dividend of 8 cents per share. This is really almost meaningless, but it's nice to see that the management is trying to give some type of return to investors at the current moment. I assume that there's going to be much larger payments, special dividends in the future in 2026 and 2027 and onwards as they ramp up the production, plateau the production at a much higher level, maybe around 14 million short tons per year. And once they do that, they'll have the ability to pay out special dividends if they're not using that free cash flow to buy back stock or make acquisitions. Now you can see that they have 3 mines, the Mine 7, Blue Creek, and Mine 4. And so nameplate capacity on Blue Creek is 6 million short tons. So adding that to the 5.6 million short tons from Mine 7 and 2.4 million short tons from Mine 4, all of this annually, you get about 14 million short tons in annual production. And this puts them just under AMR in terms of production scale. In 2026, they will become the second largest producer of met coal. And so you can see also that these mines have decades of life left. There's 20 years in Mine 7, 40 years in Blue Creek, and 35 plus years in Mine 4. So these are the perfect conditions for growing steadily the production, growing steadily the free cash flows and value of the business, the market value, the enterprise value of the business over years and years and years. And that's kind of what you need for a multi-bagger. This is the setup for a multi-bagger. Here you can see the key metrics for the 3 months ended September 30th, 2025. So they produced 2.249 million short tons, and of that, they sold 2.355 million short tons. So they sold a little bit into their reserve as well. The average net selling price per short ton was $135.87, and it was much higher in 2024 at 171.92, which is a 21% change downward. And this will pick up eventually as demand goes up and supply of met coal goes down. And this is over years. Revenue in millions was 328.6 million. Net income was 36.6 million. Cash cost of sales per short ton was $100.73, like mentioned earlier. Actually went down 18%, which is good year over year. Adjusted EBITDA, 70.6 million. Free cash flow, negative 19.5 million. And this is only because of the CapEx being spent on Blue Creek and finishing that project. And that project finishes early 2026. But once that happens, they only have maintenance CapEx for Blue Creek and Mine 4 and Mine 7. Then when they really ramp up the production and the prices of met coal go up, that could go to $300, $400 million, $500 million in free cash flow. A year ago, the free cash flow was negative $60.6 million. So that's actually a positive change of 68%. So you can see the production at Blue Creek is really affecting materially the financials and operations of the business. Adjusted net income is 36.6 million, which is down 13% from 41.9 million. And diluted EPS is 70 cents versus 80 cents, which is a decrease of 13%. Their leverage and liquidity ratio, still amazing. Adjusted EBITDA was 216.9 million. Consolidated net cash was negative 148 million. Net leverage ratio was negative 0.68x, and gross leverage ratio was 1.09x. Cash and cash equivalents, they had 336.3 million. Short-term investments, 46.4 million. Long-term, 2 million. Asset-based revolving credit agreement availability is 140.5 million. So total liquidity is 525.2 million. So they're in a great spot to finish up. And I think they're only going to need about 200 million more in Blue Creek, but they can cover that with the production increases and the actual revenue that they generate from their existing operations. So they may not even have to touch much of this to finish up Blue Creek and then increase the production even more. Their 2025 CapEx guidance was on the low end, 315 million, and then on the high end, 350 million for the total year. So their actuals were about 226 million so far. They've spent approximately 887.7 million on Blue Creek to date. The 3 continuous mining units were in operation and produced 774,000 short tons year to date in 2025 from Blue Creek. They commenced the highly anticipated longwall operations in October, and 8 months ahead of schedule and on budget, where commissioning towards full production is expected to be completed in early 2026. So this has been accelerated so much. So updated guidance for 2025, coal sales 9.2 to 9.6 million short tons, coal production 9.4 to 9.8 million short tons, cash cost of sales free onboard port 105 to 110 per short ton, which is really good. Capital expenditures for existing mines 90 to 100 million, Blue Creek project another 225 to 250 million, mine development 85 to 100 million, depreciation and depletion 185 to 210 million, SG&A 65 to 75 million, interest expense 10 to 15 million, and interest income is 15 to 20 million. It's really nice to see the increases in production based on this acceleration in Blue Creek and the decrease in the cash cost of sales. And here is the full update on Blue Creek. It's on time and well ahead of schedule. They anticipate it's going to cost a total of 995 million to 1.075 billion, and they've already spent 887.7 million, bringing it closer to the actual total and the end of the capital expenditure costs for this project. And here is the timeline. They're almost finished with this, and in Q1 2026 they anticipate the barge loadout, which is the last step of this process. All in all, Warrior Met Coal is in a fantastic spot right now, and you can see it in the huge increase, the 23% jump right after earnings. A lot of investors and probably institutional investors saw these numbers, saw the tailwinds behind the company, and bought in. So it was hovering at around $60 per share, $65, $66 per share for a long time after it jumped up from the April lows in the 40s. And now it has over $80 per share. Now, I think this still has a lot of value if you look at it from the long-term perspective. So let's move on to the AMR investor presentation and earnings. Let's go through their financial highlights, and here a lot of their financial highlights and key investment highlights are more general than HCC's. So their outlook for metallurgical coal remains robust with strong long-term demand and limited new supply, like we thought. And that works for all of these met coal producers. Largest and most diverse domestic supplier in the United States. Strategically located assets with ability to serve both domestic and export markets. Flexible cost structure enables resilience through the commodity price cycle. Disciplined capital return policy, the management here is much more in favor of share buybacks. Strong culture of commitment to safety, environmental stewardship, and continuous improvement, and an experienced management team. So let's look at how much they produced and what they're saying here. So they have 19 mines, and they're in Appalachia. They're the #1 U.S. producer of met coal. They have 8 preparation plants, 2 standalone loadouts, 1 dock, and 1 export terminal. So they produced 17.1 million short tons of coal in 2024. Their sales shipment mix was 24% domestic and 76% export. So they sell predominantly internationally. And their mix is 13% low vol, 19% mid vol, 31% high vol B, and 37% high vol A. They have $408 million in adjusted EBITDA in 2024, and then 3,960 employees. Now here is a breakdown of their mining complexes and mines. And right off the bat, you can see that they have they're a much larger operation than Warrior Met Coal with their 3 mines. I do have to note that that's why Blue Creek is so important to Warrior Met Coal, because it will put them in the same standing as AMR. Even with their 19 mines and AMR, Warrior Met Coal will be able to produce 14 million short tons compared to AMR's 16 to 17 million short tons. So this slide is very important to see what management is seeing in terms of met coal supply and steel demand. They anticipate steel demand growing steadily into the next decade, and then they also anticipate met coal supply to decline after 2028 steadily as well. So those 2 factors are a net positive for met coal prices. Here you can see that blast furnaces expected to be the dominant in the steel industry investments. So 64% on blast furnaces, electric arc furnaces at 21% investment, DRI furnaces at 7%, CSUS 4%, and hydrogen ecosystem at 4%. The majority is still going to blast furnace development. And analysts are anticipating a long-term hard coking coal price forecast continue to be revised upwards due to tight supply. So this tightening of supply will increase the price of met coal, hard coking coal, continuously. If it keeps going down like this, it will continuously go up like that in a steady fashion. Now, this is a little bit dated because once Warrior Met Coal has Blue Creek fully ramped up, Warrior Met Coal will be in 2nd place here. Alpha will still probably produce more, but Warrior Met Coal will probably be close to 14 million, beating out Coronado here. They export to 26 countries. The average realized price per short ton is $140. Domestically, $152. They make 78% of their revenue from exports to other countries and 22% domestically. And they sold 13 million short tons internationally and 4.1 million tons domestically. Now, their cost structure enables some resilience and flexibility through the commodity price cycle. Because this is a commodity, it has cycles. And so right now we're in the downturn of the cycle, relatively speaking. And then the cycle will start up again and then peak at some point in the future, in a few years. So you can see here where we reached a downturn with the COVID and they realized very small prices, average realized prices per short ton. And then it blew up in 2021, 2022, 2023 due to several factors like the Ukraine-Russia war, the tight supply chains from COVID, aftershocks from COVID, stuff like that. That really blew up the price of met coal. The average realized price per short ton exploded. But since then, obviously, the cycle is coming down, and it's expected to trough and then come back up sometime in the future. And AMR is unique in that the management is hyper focused on share buybacks as the best form of capital returns to shareholders. So they've done aggressive share buyback. They continue to say that they're going to buy back more shares and return that capital back to investors. So their balance sheet is supported by a disciplined capital management framework, capital structure. They have pro forma leverage. Flexible operations enable strong free cash flow generation. Their target minimum liquidity is 250 to 300 million. Annual capex is primarily allocated to maintenance and smaller amounts to growth investments. Capital return, this is what's important for investors. Management continues to evaluate capital allocation through multiple factors such as capital needs, investments, and growth opportunities. Track record of returning capital to shareholders in stronger years through share repurchases, a highly flexible form of capital return. And then bolt-on acquisitions. They are focused on assets that provide accretion to NPV. Synergy potentials tied to ability to integrate operations, including leveraging infrastructure and optimizing mine plan. Their free cash flow generation is going down because of the met coal prices going down. But once we see a pickup in the met coal prices, this is sure to pop back up as the cycle troughs. So overall, AMR is a great play. It didn't have the same reaction in the market as HCC did because of the tailwinds and the immediate news and things that we can see for HCC that's working in their favor. What I've been doing with this name is playing cash secured puts. So in my HSA, I've been doing cash secured puts every month on AMR at 150, 155, lower if it goes lower. And I'm just following the price action with them in my HSA, not my public account, with a cash secure put. So that way I'm able to generate anywhere from $500 to $1,000 a month. I think it's going to be relatively stable in terms of their price. They've already gone through the downturn in met coal prices. So here they're producing to bolster the amount of revenue that they bring in. So I've just been playing cash secured puts on these shares. I don't own any shares outstanding. I think HCC had the better risk reward versus AMR before this large increase in share price. Right now, HCC is fairly valued and AMR hasn't moved. It's still flat to downish. And these shares could pop up over $200 or more when the met coal price and industry starts to recover in the future. So that's it, guys. That's my take on the HCC and AMR earnings releases. If you like this content, please like and subscribe, and I will see you guys in the next one.